The University of Michigan's Consumer Sentiment Survey, which has been around for nearly three-quarters of a century, recently hit an all-time low. People feel miserable south of the border. There are several possible explanations, but I think the most likely culprit is the feeling that we're heading back to the economic vibe of the 1970s. Back then, people felt lousy due to stagflation, oil shocks, and geopolitical crises. Sound familiar? What followed as bell bottoms and polyester and disco ruled the zeitgeist has come to be described as a lost decade, where capital markets went sideways. I was a wide-eyed undergraduate freshman in September of 1982. The prof in my Macroeconomics 101 made an offhanded remark in one of his lectures that you can't make money in the stock market. And in fact, according to some people, the amount of time lost was not a decade, it was more like 16 years, from 1966 to 1982, in fact. That's how long it took North American markets to regain their previous highs. If we fast forward to 2022, we experienced a microcosm of what might lie ahead. As consumer prices surged, central banks raised rates violently to rein in an inflationary and economic freight train that seemed to be careening off the tracks. Stocks and bonds both faltered that year. The economy recovered fairly quickly, and many people who suffer from recency bias believed they could get through tough times simply because they made it through that experience. The problem is, that experience was likely tame compared to what might lie ahead. Now think about last year. In the spring of 2025, when American President Donald Trump was flip-flopping on tariffs every other week, all sorts of assets went on a roller coaster ride. These days, it sure looks like his close friends are de facto market insiders due to their taking significant long and short positions, often with considerable leverage, mere minutes before his making an announcement on social media that moves markets during the ongoing war with Iran. The 1970s pariah president, Richard Nixon, had nothing on Donald Trump in terms of unethical behavior and self-dealing. It now looks as though we're heading into an energy crisis, not unlike the one we experienced in 1979 due to trouble in, you guessed it, Iran. For stocks and government bonds to move together during an energy shock makes sense. Faltering growth hurts stocks, inflation hurts bonds. And an oil shortage raises both threats at once. Since 2022, the correlation between stocks and bonds has been positive and rising, even though it had previously been reliably negative for decades. In other words, whereas bond prices used to mostly rise when stocks fell, and vice versa, the two now tend to rise and fall in tandem. And that's a real challenge for people trying to build resilient portfolios for all possible market conditions. Specifically, that's a problem because many of the people who used the old negative stock-bond correlation to great effect can no longer count on that negative correlation. The logic of the classic 60-40 allocation relies on the tendency of stocks and bonds to fluctuate in opposite directions over short periods of time while they both appreciate in the long run. That, in turn, results in a portfolio with a steadier glide path without sacrificing too much in the way of expected returns. The more stocks and bonds move together, the worse it is for nervous investors. It seems obvious to me that we need a wider range of alternatives if we're going to keep volatility at levels that will not cause ordinary investors to lose their cool. Many advisors have behavioral coaching noted as a primary component of their job description. The problem, as I see it, is that markets have been surprisingly benign for years now. Many investors have never really had to deal with a severe and prolonged bear market. People who assume they can handle the stress don't really know for sure because they've never had to. Now, I'm not saying they can't handle a major drawdown. I'm saying we simply don't know and won't know until the situation presents itself. To my mind, it's better to preemptively make strategic portfolio adjustments to add more diversification in the hope of rebuilding portfolios to make them better able to withstand rocky times. If you're unsure of whether you can handle the stress of a major bear, wouldn't it be smarter to take risk off the table now so that you don't have to do something self-harming if it turns out that you can't take the heat?